All right, so as Lanny mentioned, why are we here today? We're here to explore how lending institutions in San Antonio can model adaptive change. And the change comes as we consider the industry standards, and it also considers meeting those federal, state, and local energy goals and designing the capital and lending structures, just as we've heard already, we do follow many of the structures and the systems that are already in place. I wonder why. Perhaps it's because lenders may be a little risk adverse. In addition to that, we're here today so that we can support the creation of these renewable energy loans at scale. Now, there's one point that I want to make when I'm talking about this adaptive change model. Citizens, people, you and me, all have values. Some of us value our work, some of us value our children, some of us value our significant others, but then we get to what we value in terms of the environment and how we value our economic viability. Every day we're making these choices. We either choose to buy a product or a service at a lesser cost, or we choose to pay a higher price because of the impact that product or service is going to have on the environment. In order for us as a community to heighten the consciousness, the awareness in our community, we truly have to have organizations like Solar San Antonio, like the utilities, CPS and SAWS, that are engaged in thoughtful system changes, adaptive changes, where we are incenting these types of behaviors. Now, the biggest Achilles heel that we have in San Antonio is the fact that we've got low energy rates. And I think that's no surprise to anyone, which is why we have to be even more creative in how we're coming up with these solutions. I want to manage expectations and make sure that everybody here, what I'm presenting to you isn't solutions. It is instead restating or defining the problem that we currently are engaged in and looking for opportunities that each and every one of us collectively, independently, collectively can bring as a solution to move these very progressive and important goals forward. So if I may just talk about our commitment, SACU's commitment to our community, which is something we call a triple bottom line. It's the people and it's planet and it's profit. And we are here, I am here, my team is here, Greg Brockhouse and Laura DeRemus, who I'll be introducing in a later point, to contribute to the sustainability and the financial growth and profitability of our organization. We are currently engaged in two markets, San Antonio and Houston, and we also have another organization called MH Lending, CU Factory Built, which is national. They're the #2 lender that provides loans to manufactured housing. And yes, even manufactured housing can use solar installation or energy efficient home improvement loans. It's also a learning organization, and we also want to use our gifts and skills to contribute to society by providing the best financing options for our members. So let me go to again, bring to you some of the challenges that we have. The challenge to finance renewable energy efficient loans, in this case, I'm highlighting the PACE program. Everybody here has heard the PACE program, and if you haven't, Lanny can hook you up on information. The opportunity is that we have residential energy efficiency that's going to help improve our use of resources, reduce the carbon footprint, and in the long term, keep down the cost of home ownership. It's not brain surgery. You reduce your energy consumption by installing energy efficiency improvements to your home or solar installations. You reduce your cost, your energy costs. It's simple. It's not that simple. The problem is that the loan amount under PACE guidelines is repaid as part of the homeowner's real property tax assessment, and the loans have superior, there's the word, superior lien status to existing first mortgages. That means the bankers in the room would have to set aside their first lien position so that in this case, the city taxing authority would take a first lien position, a superior lien. For many of the bankers that are in the room, that is something that we call not very credit worthy if we want to keep our jobs as credit officers or loan officers. So we have to come up with creative methods. We have to come up with creative solutions. So let's talk about a current solution. Do not reinvent the wheel. Lenders are vertically integrated already with the housing delivery system through direct and indirect channels of business. This is where I'd like to introduce my team. We have gone through an organizational redesign, and the indirect channel of business is currently being managed by Greg Brockhouse. Raise your hand, Greg. And our direct channel of business is currently being managed by Laura Doremus. Laura, raise your hand. The difference between the two, as many of you know in systems, is that you're going to have people, you're going to deliver products and services either directly to a consumer or to a member or to a customer, or you're going to indirectly provide that product and service. So in our particular case, we have our indirect channel that is currently having loans that are originated through third-party originators, brokers, for example. And we also are moving, because of the new redesign, contractors that would go under the indirect channel. And the reason for that is because there are obviously some additional areas of oversight that we have to manage. There are risks to an organization, and so that's why we divide them up into retail and or either direct and indirect. The direct channel, for example, is where we have a footprint of branches in San Antonio and Houston, and so members that come in through the branches or through the internet, they will come in as a retail or a direct customer. In other words, they're not touching another person or entity that is originating a loan or representing them on a particular loan. That's the distinction that I would want you to draw. So in our case, where do we go from here? Well, we already have connections, we already have established relationships in this particular case with government agencies, with realtors, with builders, with nonprofits, contractors, and the secondary market. We are a Fannie Mae seller servicer, and so we do sell loans to the secondary market, which means that we not only originate loans according to those guidelines, but we also portfolio those loans. And this is where we as a lending institution have the opportunity to adapt to these variances in underwriting standards, and we're committed to that. In addition to that, what Lanny at Solar San Antonio and our chairman, Bill, is he here? I just don't, where is he? Oh, there he is. Okay, sorry, Bill, I didn't see you earlier. I'm so glad you're here. So with our infamous leader, Bill, who has launched this wonderful vision about San Antonio becoming a solar city, you all are going to continually be challenged in terms of how we increase the awareness. But remember, I've connected awareness to these values, to these behaviors that we currently have in our society and specifically in our community. And then, of course, we have our partners, and I didn't mention this because they're not really part of the vertical integration, although they are on a construction site, but the utilities, and it is continually providing an opportunity for those utilities to incent and subsidize the opportunity to do more renewable loans. Of course, the challenge there, as we all know, is that we have our city that owns the utility, and so there's going to be some interesting dynamics that occur. And then, of course, the design standards with the builders that you talked about earlier in terms of how do we design the policies so that we can incent this type of lending to occur. So, with a quote, and that is, ladies, for you in the room, it's a generic use of the word, a man or woman should look for what is. What is the current set of circumstances that we have today, and not for what he thinks should be, because we may never get there. All right, thank you.